This is FRM Part 2, Book 4, Liquidity and Treasury Risk Measurement and Management, and the chapter on liquidity risk reporting and stress testing. This chapter was taken from a textbook called Principles of Banking by a gentleman by the name of Chowdhury, published in 2012. This guy was formerly the treasurer of corporate banking at the Royal Bank of Scotland. And I think he's retired from there and serves as a consultant and an advisor to many institutions and organizations. One of the things I found fascinating is he does have a PhD. He's been a visiting professor in multiple universities in the UK, and he's been a visiting professor of math. So that's even doubly impressive. Only 3 learning objectives in this chapter. I want to go ahead and read some of these to you. Identify best practices for reporting. Compare and interpret different types of liquidity risk reports. Explain the process of reporting. Now, I know that doesn't sound too terribly exciting. However, this is part of the identity of risk management. And so reporting is part of managing risk. So I'm going to do my best to make this interesting to you, or at least pique your interest, or at a minimum, help you answer some questions on an exam about reporting. So granted, before we start this, this is not the most exciting chapter that we've had, but nevertheless, it's still important. Let's call this first slide just a brief recap of where we are in our series of liquidity chapters and slide decks. And that first block point is important because this is really the focus of this particular chapter. Quantitative liquidity reporting, core part of the regulatory process and regime in the UK. So that's what this chapter is focused on. Of course, what are we interested in terms of regulations? Liquidity asset holdings, maturity, and then term structure, diversity of liquidity issues on the right and left-hand side of the balance sheet, and then the reliability of funding sources. Now look at that blue block. What I want you to do is skip all the way to the bottom arrow point. Notice there's a reference to the Financial Services Authority. And so that's why I told you that the publication of this textbook was back in 2012, because in 2013 in the UK, the FSA was kind of assumed or subsumed into the FCA, the Financial Conduct Authority. And so the timing element here just leads this chapter to refer to FSA. But everything else, of course, holds true. It's just now under the guidance of the FCA, which is responsible for regulation of financial services in the UK. So all this stuff here in the blue block continues to apply. All right, so these regulations are implemented by the individual liquidity adequacy standards. And so we have standards in any kind of a profession. So these are liquidity standards, and they separate those standards as they apply to larger banks, which of course have to adhere to the full complement of these standards. But then smaller banks and maybe some mortgage banks and some other kinds of smaller financial institutions have a simplified set of guidelines. So let's get to that first learning objective, which says something about best practices, which we've talked about multiple times in previous videos. And so, of course, the most important part of this is the right-hand column, I think, from a testing standpoint. I've mentioned to you in previous recordings the importance of keeping track of all sorts of risk management accounts, either by the minute. I always say minute. That's really not too relevant unless we're in a big financial crisis, but hourly or daily, clearly weekly. And so look at how Chowdhury separates this into three categories, weekly, monthly, and quarterly. But notice those top couple up there, with the ability to report daily. So I think that's an important exam question there. And so you can go through those data items on the left-hand side and work through those descriptions. But those are obvious notions. But I would know the frequency of those reports. How about the learning objective that relates to the different types of reports? So let's start with this deposit tracker report, a weekly or a monthly report of the current amount of deposits plus a forecast of deposits anticipated in the future. And what this is going to end up with is some ratio in which we're going to determine the relationship between the top right and the top left-hand side of the balance sheet. We'll call that a loan to deposit ratio. And look at that circle point. Shows how much assets and liabilities will need to change for the bank to achieve a certain loan to deposit ratio. And of course, there are other ratios out there. And what we'll see as we go through this slide deck is there are probably minimum ratios that are established, probably in-house, but maybe with some guidance from some regulatory agencies. Here's a quick example of a deposit tracker report. Notice along the horizontal axis, those are some months over the term structure. And then up on the vertical axis, there's some amounts. And then over on the polar vertical axis, there's that long-term debt ratio, and that is, the loan to deposit. Boy, I'm so used to talking about corporate finance there. Loan to deposit ratio, and notice that that's in the green. So, one thing that you notice here immediately is that the customer deposits shown in blue are greater than the customer loans, of course, because we have reserve requirements. But here, this is really cool. Notice that, like lots of, cannot call these random variables, they go up and down over time. But notice what that loan to deposit ratio shows in this particular example is that while we have variability in that the absolute amounts of deposits and loans, there's clearly a downward trend in the loan to deposit ratio. Here's another version of this deposit tracker report that is split by account type and, of course, maturity or tenor on the horizontal axis. And notice there are, blue and green and purple and red boxes there. And this is by account type. And so you can see clearly that the correspondent banks, that's in the, the light blue. Boy, look, that is really substantially increased at the 1 month and the 3 months levels. And then local authority deposits, those things are way over there in the relatively longer term. Of course, longer term, I mean, towards the end of 1 year. I don't mean 30 years. Remember, we're talking about liquidity here. And so just looking at this kind of a report gives you a sense of the type of an account and its relationship to liquidity and liquidity needs over time. Here's just a quick summary of what we can learn from those previous two graphs. Significant contribution made by current accounts and those rolling deposits. Little fixed term deposits. And so look at that third block point here. And this is all about managing this liquidity risk. So if we have little fixed term deposits, then perhaps we can call up our smart marketing people and say, hey, let's figure out why this is true. And let's do some kind of a marketing campaign or some kind of an increase in the possibility of increasing the demand for those types of accounts. How about a daily liquidity report? Presents the bank's liquid and marketable assets in a straightforward spreadsheet up to 1 year of maturity and maybe even beyond. And so I have an illustration here. Notice we have different accounts down the left-hand column, and over on the right side, these are divided by dollar amounts for each particular type of account. But then in the bottom, we do this in terms of maturity. So we've got important information on the top right and important information on the top left. And this gives us a sense of what our needs for liquidity are going to be, over the next couple of weeks and then months and all the way up to a year. So it's important to know the amounts, but it's also important to know the amounts given by time. Moving on to the funding maturity gap report. I've said this to you guys many, many times. We accept deposits and we make loans. And in a perfect world, the deposit maturity or duration would match the loan maturity or duration. Notice I put the or duration in there. Can't forget about duration and convexity. But nevertheless, there's going to be some kind of a mismatch, short-term over there in the top right-hand side of the balance sheet, long-term over on the top left-hand side of the balance sheet. So this mismatch report is going to give us a sense of, what's happening. Do we have lots and lots of inflows or lots and lots of outflows? And so we have another illustration here with inflows and outflows over the next, that goes up to 30 days. And then we squeeze in a year at the far right-hand side of the horizontal axis. And so notice we have some trend lines. There's the cumulative cash flow and then the adjusted cumulative cash flow. Of course, that adjustment is made for the highly liquid assets. And remember, I've said this to you in previous recordings. I always think of those highly liquid assets as treasury bills, although they can include a whole host of highly liquid securities. But in my mind, that's the way it works. And so that makes sense that dotted line would be above the constant line, the solid line, mostly because of our investment in those highly liquid securities. Another type of report, a funding concentration report. Look at the first block point, crucial management information. Of course, this is crucial management information. So think about this, funding concentration. Now, here's the example that I thought of as I was reading through the chapter. Let's suppose I'm Jim's bank and I'm an Arkansas bank. And let's suppose that I grew up with Sam Walton. And we were best friends growing up as kids. We went to high school together. And then Sam Walton grows up. Of course, he founds Walmart. And so, of course, the headquarters of Walmart is in Arkansas. And Sam says, hey, we're going to do all of our business through Jim's bank. So I become a bigger bank as Walmart grows. And then Walmart expands to different states. And so maybe I'll have some subsidiary branches or some branches in other states. But let's suppose one day Sam decides to move to Canada. And Sam comes to me and says, hey, Jim, can you put a bank in Canada? And I scratch my head and I say, well, Canada has a lot of different rules. And I'm not sure I can meet all those rules. I'm not sure I want to meet all those rules and requirements. I'm not sure I want to do this. Why don't I just pick up the phone and call a bank up there, and we can just flow through all of those transactions through that correspondent bank. So I develop a relationship with this correspondent bank in Canada. Sam Walton is happy, so the cash flows come through that correspondent bank, and then they swing back to Arkansas to my bank. And so this funding concentration report, and let's pretend that Sam Walton has Walmarts in every country throughout the world. So I've got this relationship with correspondent banks all throughout the world. Well, this report is going to give me a sense of the concentration, right? Boy, if I'm spread, look at the funding diversity in that second block point. If I'm equally spread throughout the world, then it's probably not too much of an issue. But if I'm concentrated in one or two correspondent banks, well, then there might be some risk associated with, funding or source of funds or deposits or any of that other kind of stuff. How about an undrawn commitment report? So this is off-balance sheet financing, which includes things like revolving lines of credit or liquidity lines. And so this is extremely important for us to have a sense of what that means for today's liquidity and then next month's liquidity and next year's liquidity. And let's just take an extreme example. Let's suppose that we as a financial institution, we've extended lines of credit of up to, let's say, $100,000, with 10 banks. And so what we need to do is see, okay, what happens if all 10 of those financial institutions out there or corporations or businesses or organizations, let's suppose that they use their line of credit over the next month or the next 6 months or the next year. And so that's what this undrawn commitment report will illustrate. And then here's just a quick graph for a couple of months going through here, maybe up to a year or a little bit longer. Notice there are 2 squiggly lines there for the total and then from subsidiaries. How about a quick liquidity profile? The first thing that caught my eye when I saw this particular graph in the chapter was that my students, they love to draw graphs whenever they do something, and they always like to do the pie graph. So that's what this thing is. And of course, look down the right-hand column over there. These are just all of the liabilities that we have on the bank. And of course, each individual bank is going to have different kinds of liabilities over there. So good pie chart is always important. Now, we can also do this to include wholesale pricing and volume. And what this is important for is not only for internal use, but also as regulatory checks regarding what our competitors are doing or our peer financial institutions are doing in terms of, pricing and volume at the wholesale level. And so here's just a quick illustration of a yield curve. Notice that that's a spread in basis points over there going up the vertical axis. And we go all the way out to, 5 years. And I guess we could go beyond that, but it doesn't make a whole lot of sense to go beyond much. Notice it's upward sloping for each of the accounts we have over on the right-hand side. And so this makes perfect sense, right? Upward sloping yield curves. Now, of course, we've got to put all those reports together in a summary report. Presented as a 1-page summary. Here's the guideline that Chowdhury offers us. I always tell my students when they're writing summary reports or they're writing papers, they always want to write as little as possible, but then when they realize all of the parts of the rubric that go into the assignment, then they want to write a 5-page paper. And I always say, look, nobody really wants to read a 5-page paper. Nobody really wants to even read a 1-page paper. But all right, so this is what we're doing here. We're going to summarize this, and we're going to put it to one side of A4. Remember, the A4 is like the general accounting stuff, which will include a liquidity section. And here's a good quick example, hypothetical monthly liquidity snapshots. So notice we go from a day all the way out to a year. There's our cumulative net cash balance. So notice that not much change over a couple of days, but then at the end of the week and then at the end of 2 weeks and at the end of the month, boy, that cumulative net cash balance turns negative. And then, we kind of decline all the way out to a year. In this hypothetical simple example, we don't have any other forecasted inflows and outflows. So we've got this gap there. But then notice that next row, counterbalancing capacity. All right, this is really important stuff, right? We talked about in previous recordings, we talked about a liquidity buffer. I want you to think about this counterbalancing capacity as part of the liquidity buffer and an important part. Remember, I always said this, and I just said this a few moments ago. I always think of a buffer or liquidity as a treasury bill, but there's other securities out there. So in this counterbalancing capacity strategy, this is a scenario under which the financial institutions use other highly liquid securities. So let's think about an example. Let's suppose that on our asset side of the balance sheet, we have some treasury bonds that'll go into the buffer, but we also have some debentures issued by a AAA rated company. All right, so they have some credit risk, right? Unlike the treasury securities, but since they're debentures, they're unsecured. I think the accounting term and the risk management term is unencumbered in that counterbalancing strategy. So you combine those two, that counterbalancing capacity includes those unencumbered securities as part of the liquidity buffer. And that gets us to a liquidity gap and a variance. We can also do something similar by computing some kind of a liquidity ratio over a 1 week or a 1 month time period. Notice we've got these limits here. There's some X limits and some block limits. Those are a 1 week limit and a 1 month limit. And so notice that these ratios are all above those limits, going from, what is that, May of 09 to June of 09. So we've got that time period covered in this liquidity risk report. All right, so now what we've done in the past couple of slides here is we've kind of got ourselves caught up to speed about best practices and types of liquidity reports. But what's important inside of these series of chapters is stress testing. All right, so what we need to do is we need to make sure that we We need to make sure that we do some stress testing on all of these liquidity reports that we have estimated and computed and compiled. So look at those circle points. Recognize the firm's liquidity position and then take mitigating actions. And so here are these stress test reports. So cash flow survival report. And what I'm going to do is I'm going to swing back to all the way back. Here we go. Here's our cash flow survival horizon. So this is just regular old liquidity stuff. Now what we want to do is we want to replicate this cash flow survival horizon under specific liquidity stressed events. Whatever those stressed events are, spike in inflation, spike in interest rates, spike in oil prices, et cetera, et cetera. We want to put something like this together under stressed environments. And then we want to put something like this together under stressed environments, 1 day, 1 week, and all the way up to a year. So let me go back to where was I here? Okay, so a stressed cash flow survival report and a stressed cumulative cash flow forecast. And then, of course, it should include some of those or all of those, possible stressed events. So this is where I want to go back to things that we've talked about in the past, where it sounds an awful lot like, boy, an Excel spreadsheet, even a complex Excel spreadsheet might help us with this stressed forecasting. But I want to remind you guys of the value of Monte Carlo simulation. So you can do all this stuff inside of Monte Carlo simulation. I mean, you can do it in Excel, but you have to be really super smart and super patient and super technical to be able to get all of those cells written correctly. Let's just go ahead and get a really smart person to help us with a Monte Carlo algorithm so that we can include these kinds of stressed events into that cumulative cash flow forecast. All right, so what do we get when we have these outputs, whether it's Excel or any other kind of model that's going to give us this particular type of an output? So a 1-slide summary of the stress test, Excel, Monte Carlo, or some kind of an internally generated report that can be used by senior management. We're going to do this every quarter, and it's going to show sensitivity. Of course, it's going to show sensitivity. So we've got the stress tests of a combined shock. This shock. What did I do previously like this? We got this combined shock. How does it affect the entire liquidity position? And then how does it affect, each individual business unit? How are we going to treat these cash flows? Allowance for behavioral adjustment of retail deposits. Boy, I always love when authors tell me about behavioral issues. Remember, I've said this to you before, behavioral errors, cognitive errors in the brain and emotional biases in the heart or the soul. And so you really can't predict behavioral issues from retail customers. And then, of course, we have to ask ourselves one final question. What about stuff that goes off the balance sheet, like derivatives, like special purpose vehicles, like, bonds that are held outside of the balance sheet, et cetera, et cetera. And so what we're going to do, look at that final block point, and that's probably a good way to memorize this. A conservative approach to the treatment of expected cash flows is recommended. And that takes us through our learning objectives. And so, I don't think this was too dull as we've gone through this. But those first two really are kind of standard stuff. So you need to know exactly what that best practice is, right? The weekly and the monthly, and then those different types of reports. So know the type, what goes in the report. But then I think the more important or the most important learning objective here is that liquidity stress test, because that's the series of chapters.